Welcome to World DNA. This is the part 5 of our advanced option strategies course, and in this part we are going to cover our fifth strategy in this series, that is called covered calls. So this is a very special strategy, and this strategy is used by mainly those persons who are holding the stocks and want to earn extra income on their holdings. So we'll look at it. This strategy is used by many fund managers, hedge funds, to in order to earn extra income on their stock holding. So we'll discuss this professional strategies as adopted by pro traders. So let us begin. So a disclaimer: all the material presented in this video are for your information and educational purposes only. Kindly do consult your financial advisor before taking any trade. So strategy number 5, covered call selling. So what are the characteristics of this strategy? So this strategy is a neutral strategy. It is a credit strategy. That means you receive option premium. That means in this strategy we are going to sell options, and as the name suggests, we are going to sell call options. So this is a non-directional strategy. Although it is a slightly bullish strategy, you want your stock to go up. However, even if your stock falls, you can earn extra income on your stocks. So we'll discuss it in detail later on. So the difficulty level: this strategy should be used only by those traders who have currently stock holdings, which are carrying the stock position in their accounts. So this strategy should be used by those investors. The profit level is limited, of course, and the risk level is also limited. So let's dive into this strategy. So what it is actually covered call? What do you mean by covered call, and when to use it? So what is it? It involves selling out of the money call option for the strike price at which you will be happy to sell your existing holdings of stock or underlying. So what does it mean? Supposedly you bought a stock at $100 and you want that this stock should go to $110, and I will be happy to sell this stock. So meanwhile you waiting for this stock to go up to $110, you can earn extra income on this stock, or you can reduce your cost of investment. How? You can sell $110 call option for which you will receive some premium from the option buyer. Supposedly you receive $1 for selling $110 call option. So this $1 is your extra income on your stock holdings, and until and unless this stock goes to $110, you will keep this $100 as a premium. Even if this stock goes to $110, you are already waiting for this stock to go $110. Now you can keep the $1 and sell your stocks at $110. What will happen? What will happen in case stock falls to let's say $90? You can keep your stock, your favorite stock, and still you keep the $1 premium collected in first place. So by doing this on month on basis, what you can do, you can reduce your cost of investment. Supposedly you waited 5 months for this stock to go to $110. Meanwhile, you can collect $5 premium. I am assuming that you are selling monthly options. You get the $5 premium for selling $110 option 5 times. And what would do this? What would happen? That your cost of investment now, instead of $100, is reduced to $95. So this is the magic of covered call selling, and this strategy is used by large fund managers, hedge funds, in order to reduce their cost of their stock holding. It is simply a way of earning extra income on your stocks which are lying in your portfolio. So when should we use it? When you are long on a stock, you are holding a stock and waiting for it to go to upside. Okay. Then meanwhile you are waiting for the stock to go up. You can sell out the money call option for such strike price at which you will be happy to sell your stock. So in this example, you will be happy to sell your stock at $110. You can sell out of the money $110 call option and receive premium for it. So you can earn extra return on your holdings while you wait for the price of such stock going to a desired selling level. This is called original yield farming. So this is the a way of earning extra dividend or extra money on your lying stocks. So this is just the example, pictorial example of what we have discussed in previous slide. So this person is holding 100 shares of XYZ company and bought them at $100 per share, and he is waiting for it to go up to $110, then he can sell his stock. So he is waiting for this stock to go to $110 and he would be happy to sell this stock. So the problem with this person is that he is thinking that this is blocking my capital. 100 shares for $100, that means $10,000 are blocked. $10,000 are blocked of his capital in this stock. So he want to earn extra income on those $10,000. So what he can do, he can sell $110 call option for next month. Let's say such option is trading at 0.50 per option. Thereby he collect the $50 premium, 0.50 into 100 stocks. Now the three things could happen on expiry. So what he does, he sold $110 call option and collected 0.50 cents for it. So this was his position, and he also is holding 100 stocks of the same company. So what can happen on expiry? Let's say instead of rising, this stock crashed. This stock crashed 10%, it comes down to $90. So what would happen is, he can keep all the $50 premium that he collected from selling call options, and his unrealized loss on such stock would be $10 into 100. However, as he loves this stock, that's why he bought them in first place, he can keep these stocks. It is a win-win situation for him. He keep all the $100 all 100 shares with him. Also he get the extra $50 on this holding. So isn't it good? I think this is a very good position. It will reduce your unrealized losses somehow. Okay, the next scenario, suppose the stock do shoot up and it goes up to $110. So what he can do, he can let the option expire. So the option will expire at worthless. He can keep all the $50 premium with him, and the $100 the target is reached and the option also expired worthless. He has both the option. He can either sell the stock at $110 or he can keep the stock with him. So it is again a win-win situation. What would happen if the price shoot up to $115? So the stock really rallies and break out all the resistance and went up to $115. So what would happen in case the stock goes to $115? The $110 option sold will expire at -$5. That means he had to pay this much to option buyer, and he can sell the stock at more $5 profit above $110 plus $10 profit original. So in this case as well, he earns $15 from stock holdings and lost $5 from selling call option, plus he collected 0.50 at initial state. So even in this case as well, he will earn $10.5 on his holding per stock. So this is the power of this strategy. I think this strategy should be used by all those investors who are holding the bags of shares. They can earn extra monthly income on your stocks. So what are the initial Greeks of this strategy? So in case you do not know about Greeks or only have basic knowledge about Greeks, I do recommend you to kindly go to our previous playlist and watch the advanced option Greeks course. So this is a very useful course for all the option traders, and I strongly recommend all of you to kindly go and watch our playlist. So what would be the initial Greek of this strategy? Delta. As you have sold options, the delta will be negative. As you have sold call option, that means you want stock to fall or either remain sideways due to call sold. The gamma, of course, selling option creates negative gamma. Any gapping move on upside will shoot the prices of call sold, so gamma will be negative. Theta, of course, selling options involves positive theta. If nothing happens and day passes, your position will earn daily decay. And what would be the vega? Credit strategies have negative vega. That means if the IV goes down, it will be profitable for your situation, and if the IV goes up, it will be against your position. So how this strategy earns or loses? So this is the payoff chart of bear call strategy. So in this chart you will look, as soon as the stock starting to rise, you will earn profit, and the profit will be limited after this point. What is this point? This is the strike price of sold call option. The strike price of sold call option, that is $110 in our example. So beyond $110, your profit will be limited and it will not rise. And on the downside, the loss is just similar to buying a stock. There is no limit on the downside. However, the stock cannot fall below 0. So the downside risk is similar to buying a stock, and upside profits are similar to buying a stock. However, after the stock crosses the sold call option strike, your profit will be limited. So max profit achieved when the stock price reach called sold strike. And the downside break even point is purchase price minus premium collected. That means $99.5 in our case. So this is the payoff chart of bear call spread. Hope you have understood it. Now let's move ahead. So how the covered calls are adjusted. So we'll discuss what should be the adjustment that can be made in covered call selling, and all these adjustments are totally dependent upon your conviction whether you want to remain in that stock or not. So as this is a special strategy for earning extra income on your holding, its adjustments are purely dependent on whether you want to remain in that stock or not. So case 1, in case the stock falls but you still want to remain in the stock, $100 stock fall to $90, but you still want to remain in the stock. What you can do, you can book profits on your $110 call options sold in earlier place and bring down its strike price to, let's say, $105 and collect more premium from it. So this is the number one adjustment that you can make if you want to remain in the stock. Case number 2, in case stock falls but you don't want to hold the stock. So whenever you don't want to hold the stock, close the trade and get out of the trade. Case number 3, in case the stock rises but you want to remain in the stock. So in case the stock do rise from $100 to $110, but you want to still remain in that stock, what you can do, you can book losses in the $110 call option sold, and you can sell further out of the money, let's say $120 call option, in order to earn premium on it. This is the third adjustment that you can make in this strategy. Case number 4, stock rises but you don't want to hold the stock. So whenever you don't want to hold the stock, the adjustment is very simple: close the whole trade and take out of your money. So these are the prospective adjustment of covered calls. Hope you have understood it. In case of any query, kindly do comment below and subscribe our page for upcoming new strategies. Also, I recommend you to kindly visit our website worlddna.tk and subscribe our page, Twitter page @WorldBusy, where we update daily analysis of world financial market. So thank you for watching.